I don't normally do presentations for Real Vision Television as me as the front man, but sometimes some things come up that are so important that I think it's worth going through in depth and in some detail. One of the things that I've been writing about for a long time in the Global Macro Investor, my own research publication, is about the law of unintended consequences, and something that's happening right now that I think is really of major importance, and I'm not sure how many people truly understand how important this is. Again, with most of these things are about probabilities and not about certainties. So I'm not the forecaster who's saying I can see into the crystal ball. I'm saying there is a certain set of events that very well may happen and probabilities in the favour of it happening. And if that happens, certain other things may well happen. So you need to understand the framework of probability to understand that how I look at the world. Anyway, the thing I want to talk about, as I mentioned, is this law of unintended consequences. The media is full, the mainstream media certainly is full of the Japanese and their devaluation of their currency via quantitative easing. Obviously, most of us in the financial markets are also waiting for the Europeans to do something. We have this great belief in quantitative easing as being some kind of panacea to solve the world's problems and reflate asset prices. As you know, I think from Real Vision Television, from many of the people we've had on programs, that they don't really believe in that, believe that there's other prices to be paid. I guess most people thought about the price to be paid for this was going to be a rise in interest rates. That was the great trade of this year. Something, luckily I was on the other side of, but that doesn't always happen. But the point is people thought interest rate rises. That was what's going to upset this apple cart. And then something else happened. Something else happened that nobody was expecting. And that thing happened, and that's the strength of the US dollar. The US dollar is the biggest asset class of all. It's the daddy of all macro variables. It's the most important thing that we know. It's the reserve currency of the world, let alone just the United States. So as I mentioned, the Europeans have started looking at some larger form of quantitative easing. We just had an ECB meeting today. And again, as ever with the Europeans, they've let the side down and haven't done what people expected. But it's coming, and they like to flag these things a long way in advance and make sure that all of the details they need for this are right. But I think what's happening now is we're getting to levels in some of these currencies that we've not seen in decades. So, and I don't mean the absolute level, but the technical level. So some of this is going to be quite technical, charty based, but I think it's very important because you need to understand charts to understand market dynamics and the likelihood of events happening. So I think the first thing we need to look at is the chart of dollar yen. The dollar yen chart has now started to break out of its key kind of support levels that it's formed over the last 10 years or so. Now that's really crucial because what happens is it starts to change people's mindset, thinking, well, maybe the yen doesn't always go up in value. So the chart of the yen, as I'm showing you, is the chart to show that the yen going up is actually the dollar going up versus the yen. I know it's a bit confusing, but that's how we look at things in the financial markets. The thing for me now to confirm the trend change would be to see the previous level, the previous high getting broken. That's around 125. Between that 125, 135, which is the level prior to that, those are the really key areas. If we start breaking through those, then people who've had the long yen position or the dollar yen position on for so long are going to start getting washed out. Then when we flip over to the euro, you can see it's one of the biggest chart patterns I've ever seen. It's a very pure chart pattern because it's a convoluted head and shoulders, but the neckline is very clear and clean. And that neckline is around 122. So should we start to break 122, then almost anybody who's owned euros over the last 8 years is about to lose money. That's a significant thing. If you think of the mindset of the market, what would happen? The most likely outcome is people start getting out of positions. And it's not really the financial market participants per se, but the knock-on participants, the pension funds who just don't hedge or hedge in a certain way currency risk. And it's the corporations who didn't think about the euro. They thought, well, it's stable against the dollar. That stability has led to people to make bad investment decisions. They've forgotten to hedge. They've forgotten that currency risk is the big risk in all asset markets. So that's where I want to look at is let's look at the dollar per se. Forget about the two currencies that are leading the dollar right now. I think there is a risk that if we look at the actual dollar index, the DXY, that we're about to break probably the largest ever technical level in the history of fiat currencies. And that's a big statement. And again, I use the word probability because we're not sure it's going to happen, but it's starting to butt up against that huge downward sloping wedge. The huge downward sloping wedge is a reversal pattern. It's a very good technical pattern, and it looks like it's just about to break. We've also broken a small inverted head and shoulders. Well, small, it's still multi-year, but the larger pattern is obviously going back till the 60s. It's a huge pattern. Now, should we break this wedge and take out the previous high, which is at about 90 in the DXY, and we're currently, as speaking, about 88, then we've got something changing dramatically in the dollar. People are going to have to think about having dollar-denominated risk or hedging other currency risks against the dollar. So if we look at the DXY, which is a basket of currencies against the dollar, mainly euros, yen, Australian dollars, and a few of the other major currencies, if we think that that may break its trend and see a change of trend, what does that mean? Why do we care? What is the unintended consequence? Well, the first thing that people didn't realize, and a lot of the people who have been short bonds didn't realize how deflationary a strong dollar is. It's one of the most deflationary things in the world because so many currencies commodities are priced in US dollars. And once the US dollar starts going up, they become cheaper. So firstly, if we look at the chart of the CPI, the US inflation against the dollar, you can see the clear correlation and the fact that the dollar is currently pricing a negative CPI. This is why the bond market's rallying so hard. This is why everybody's offside. Everyone's worried about interest rate risk when the fact was it was currency risk that was the big deal. I think the CPI element I'll come back to shortly, and that's to do with commodities. And that's one of the knock-on effects of this. And how I like to look at things, I like to look at the knock-on effect of the initial move. And that's where the interest lies, that's where the trade opportunities lie, or the risks lie. But the first knock-on effect, I think the most important one, the one that least people understand. People understand the dollar and oil, for example, a bit more, or the dollar and gold, for example. But the big one for me is the global carry trade. The global carry trade is essentially where people are borrowing dollars and investing abroad. If you imagine the Fed has been pumping all this money in to the US banking system, and then it's leaked itself out through the global banking system, and that money has been borrowed in US dollars and then invested in whether it's Korea or whether it's Brazil or whether it's Argentinian bonds or whether it's Chinese carry trade. That position right now is probably the largest position the financial markets have ever seen. My particular guesstimate on it is about 5 trillion. I think the BIS number now just came out recently, suggests it could be $9 trillion. These numbers are huge. And there's no amount of QE can stop some of these trades once they start happening because that's too big. So let's understand what that means. What it means is, I'll start with China first. The Chinese have been taking part in this global carry trade because what they have is they have a dollar which has been trading in a band, and their currency has been pegged essentially to the dollar. It's been appreciating slightly, even better. So they borrow dollars, they get that 3 or 4% appreciation a year. In addition, the interest rates internal to China are higher than the US. So they get the pickup between the difference between the interest rates. But on top of that is the people who are undertaking this also then invested in special purpose vehicles in China where they get much higher yields. So they're getting 15% yields. Okay, some of those numbers have dropped somewhat in recent times. But the problem is if your dollar, which is your funding currency, is stable, that's fine. But once that starts moving and coming stronger and you haven't hedged it, and you can't hedge it because that takes half the economics from the trade, you find that your profits suddenly become losses very quickly. And you have this huge concentration. I think the Chinese carry trade is somewhere between $2 and $3 trillion. That all of that money is at risk of being hot money and flowing out once the dollar gets stronger. If that's the case, then we've got a big issue, and there's a very high risk that the Chinese will have to devalue their currency, not revalue it as people have been thinking for a long time. I think the key thing here is understanding that China doesn't operate in isolation either. So if I'm talking about a Chinese currency devaluation, the thing that backs that up to me, I like to look for supportive evidence in these kind of things. The supportive evidence for me is the fact that the yen has weakened so much. The yen is one of the main competitors to the RMB in global trade terms. So if you look at the chart of the yen versus the RMB, you can see the yen has depreciated massively. Now that's a big problem for China because suddenly they're uncompetitive. Now, if you think about how the rest of the Asians work as well, they're all mercantilist, which means they're based basically on trade. and using their currency as a way of making themselves less or more competitive, not necessarily via productivity or not necessarily via innovation. So you've got an issue where one of the Asian currencies is devaluing sharply, and it's one of the biggest ones of all. So in which case, it creates an issue for the others. They start to think, well, maybe we need to allow our currencies to weaken. But also, before all that mindset changes, you tend to find positioning starts to change, because if the dollar starts moving against the yen, against the euro, against the RMB, well then you're thinking that the Chinese economy is slowing, and the currency is going to weaken, so the chances are that the Aussie dollar goes, maybe the Kiwi dollar goes, maybe the Canadian dollar goes. So you're starting to pick up more and more currencies. And that's what that big DXY wedge is telling you, is this is going to broaden. We're going to get more and more currencies involved in this weakening. And I think the RMB is probably the big one, because it's one of the best risk-reward trades on earth to take the other side on right now. The devaluation is virtually not priced into any options market. Volatility is incredibly low. And I think Mark Hart in a previous video and a couple of the other people who've appeared in Real Vision Television have talked about that trade. And I think that's one of the key trades coming for 2015, 2016. It may not happen, but to bet against it is very cheap to do. So that makes it a sensible investment to make. But when we look at the other emerging markets, if we think of them, the amount of money that's flown in between that 5 trillion and the 9 trillion number, imagine if that starts having to come out because the dollar's moving against them now, so suddenly their funding currency is going the wrong way. That can create huge issues. Now, I think that's about to happen because most of the charts of these currencies are telling me that. And I think also that mercantilist trade policy is going to create further and further issues, that there's a pressure for people to devalue their currencies. And that's not just, don't forget, in Asia, because the Brazilians compete with the Indonesians, and the Brazilians compete with the Russians, and the Russians compete with somebody else. And what you have is a very interlinked global trade world where people just can't allow their currencies to devalue that much. There is something going on in the background, and that's to do with China creating currency swaps with its trading partners. And part of the reason I think they're doing this is that they're also undertaking more of their commodity transactions in their own currency. And the reason for that, I believe, is it allows them to devalue their own currency and kind of trade down with all of their trading partners. So they're operating as their side kind of currency group and let the US dollar revalue. And if the US dollar revalues, it's actually kind of economic warfare or currency warfare with the rest of the world. And I think that's a geopolitical thought out strategy as well. The other thing that tends to happen once the dollar starts strengthening is developed markets, particularly the US market, tends to outperform emerging markets. That's in equity terms I'm talking about now. And part of that is the currency trade, and part of that is just it makes it more difficult for certain countries to make money. Now, what happens is, if we go back and look at the last few times we had a huge dollar bull market, in the 80s, the early 80s, we had a massive dollar bull market, the biggest there's ever been. That bull market was the start of the LATAM crisis. All of the hot money had flowed to Latin America, South America, and that all blew up as the dollar started to rally. And that creates a self-reinforcing dollar bull market as all these positions get closed out and people's mindset changes. And that's one of the reasons currency market trends tend to last longer and with less volatility than any other asset class, because they become self-reinforcing, and it's not just market participants, it's the corporations, it's the pension funds, it's the people who didn't really think about currency suddenly start thinking about currency in a different way. So if we look at the chart of what happened back in the early 80s dollar bull market, you can see something incredible. As the dollar started to rally, which is the DXY on the chart, you saw the emerging market equities cratered. The exact same pattern happened back in the 90s, the late 90s, where we saw the Asian crisis. Again, the dollar started rallying strongly, and before you know it, the whole of Asia blew up. And again, the equity markets in that case fell about 50%, 60%. In the previous example, it was about 45%. But the point is you get a huge move in global equity markets. Now, that doesn't mean the US, because it's the outperformer, stays up. Often it enters a bear market too. Both of those times we saw bear markets, less so in the US in the late 90s. But that's the thing I'm worried about, is that we're about to enter this kind of self-reinforcing currency and emerging market crisis that I think will blow over and move towards the developed markets too, because the exposures are so high, again, within the banking system, within the pension system, the insurance system, and all other parts of this. Just to understand this risk a little more clearly, I think it's a really great chart to look at the chart of, let's say, the MSCI Asia versus the DXY. And you can see the correlation was so intense, and then starting to break down as the dollars collapse, I think we're going to play catch up. We can see exactly the same pattern in the overall emerging markets index, where we could use the ETF EEM, which I think is probably a good short right now, where it is diverging from the US dollar. I think the US dollar is the asset class that leads, and in which case I think we're about to have an emerging market shock, and I think it's coming either the tail end of this year, maybe even starting now, and I certainly think it's going to spill into next year. The moment the dollar starts breaking these key levels, if it breaks the key levels, if it doesn't, all bets are off. We don't need to worry about it. But if it does, then the probability of something really bad happening in emerging markets goes extremely high very quickly. So that's something I think we really need to keep our eyes focused on. We need to focus on the RMB, particularly the 12-month forwards, where we can see if there's any stresses in that. They're already looking like they're forming an inverse head and shoulders pattern, which you can see on the chart at the moment. And then we need to look at, is the euro and the yen and the Aussie dollar going to break their key levels? If you look at the Aussie dollar, it's formed a huge head and shoulders top pattern. Looks like it's breaking now, and we're about to get the accelerated downside. And again, apologies for all the charts, but this is a very chart-based presentation because it's the best way of getting across all the information that we need. The other chart that's becoming very interesting to me is the chart of the ADXY, which is the Asian DXY, but basically a basket of Asian currencies against the US dollar. That includes the RMB, but also the broader range of the Malaysian ringgit and the Indonesian rupiah and etc. Now that chart again looks like it's at its very key levels. So what we're doing is we're raising the probability because we're not seeing a chart pattern just in one currency. We're seeing it in multiple currencies and all across the globe. And when you see that kind of thing, you take it very seriously because you understand that if you break those key levels, everything's going to go, and it's going to go very quickly indeed. The other thing you need to understand from that is the faster the dollar goes up, the more deflationary it is, the more the bond market in the US rallies like crazy. And I think the deflation will spread out from the US, so this is not an inflationary event anywhere, even in Europe. It's likely to be a deflationary event. And what we'll see is European bonds going to even lower yields. I think we're going to eventually, at the end of this, if this dollar bull market plays out as I think it will, I think we're going to see 10-year yields in Germany in the low 20 basis points. We may see 10-year yields in the US well below 1%, probably down to 0.5%, and we'll start to see the yield curves kind of inverting. We can't have an inverted yield curve in a world of zero rates, but you'll see something that becomes very close, which is probably something like 100 basis points in the yield curve, which in the old world, when we had interest rates, that would be actually an inverted curve. And that's an issue because it's telling us that the world can't take a stronger dollar either. The economies won't take it. The US will not be able to take a very strong dollar. I think the shock impact on the US economy is much higher than people understand. Right now, I think the naive view that, oh look, the oil price has come down, isn't that going to boost the consumer? That's misunderstanding the magnitude of what is out there. And let's move on a little bit to commodities, because that's where part of the epicenter of this is. And you need to understand that in a little more contextual detail. If you think if you look at the chart of oil against the DXY, again, huge correlation, you can see they're pretty much following each other. The DXY is currently pricing the price of oil down to about $50. That's currently now. So if the dollar starts moving further, then my previous targets, I think some of you have seen before, where I think the oil price could get down to $40 or $30. That's very likely if you look at the chart of the dollar. Now, obviously, that's massively deflationary. Now, it may be good for the consumer in one respect, but it's probably not good in another. It's not good because the amount of lending that's gone on to all of this oil patch boom, not only in the US and Texas specifically, but all across the world. What happens is a lot of these shale oil producers, the higher cost producers, they're all unprofitable. So they shut down production, that shuts down jobs, that lowers GDP. We also look like we've got a lot of junk bonds that's priced that were financing the oil boom. Now that's going to be a huge problem as well because those junk bonds blow up. It's bad for the pension funds. It's bad for people who take risk because how you think about risk is it's like a basket, and if you tip one thing out one way, you have to tip something out the other. So if you're puking risk in junk bonds, then you end up having to readjust the rest of your portfolio risk. And that's what tends to lead to these waves of selling that can happen. And I think the likelihood for me is it's going to come. And it looks like to me 2015 is a year of recession and a year of falling commodity prices and a year of a hugely strong dollar and a massively rallying bond market. Now this is fascinating to me because I'm a macro guy. And this is the true macro environment. We don't see many of these in our lifetimes. And if I'm right, There's going to be some great opportunities, there's some huge risks, but these are things that will trend, and they'll trend for a long time. Now, if you think about what this means, it means that the world that we knew, the safety of income and yield and carry trades, because we had a low volatility world, well, that's about to change. The likelihood is we're going to live in a high volatility world or higher volatility world. And that makes asset prices difficult to value in certain ways. It also means you can take less risk. So it means that the kind of global financial leverage tends to shrink in this environment. And I think that itself is a self-reinforcing thing for the US dollar, because so much dollar debt is out there. Most debt generally is referenced in US dollars by the end of the day. So if you shrink that, you're essentially taking dollars out of the system and the dollar goes higher. So that pushes the whole trade even further, creates more knock-on effects. More people have to devalue their currencies. The knock-on effect is more than just the falling oil price or the rising yen. It's a much broader thing, and that's the thing we need to understand. And I think now we're into the understanding. I've rushed through a lot of charts because there's so much to look at, and I know you're going to have to sit down and think about these things, look at the charts yourself and understand this big picture, because it's probably quite a lot to take in one go. But the thing is, what I want you to look at is some of the trade ideas that come off this, or some of the risks you need to hedge, because this is quite important. So at the simplest level, I think the easiest trade in the world right now is to own US dollars via the DXY. However, the trades run quite far, the positioning is quite big at the moment, and I think there may be a washout. So I think if you can, wait for the washout and buy that, because that would be the pause that refreshes before you see the next and huge run higher. I think that's about to come. That's probably going to come towards the latter end of the year, maybe into early next year. So that's key. So DXY, you can trade it via futures, and I believe there's ETFs on the dollar. So you can trade all of that. I think that the EEM, which is the emerging market ETF, I think that's a straightforward short. I think you might be able to do that in advance of the big dollar move, because I think that's still yet to be repriced. There are other knock-on effects in other commodities. Copper, for example, hasn't fully priced in this move. I think that becomes something interesting as well. So I think we can look at the copper market. I think we can look at spreads of developed markets against emerging markets in terms of equities. You can buy one, sell the other. You can do it via ETFs, or if you're more sophisticated, just do it via futures. I think that becomes more interesting as a trade. I think over in Asia, there's plenty of currency bets. If you're more sophisticated, then I'd highly recommend getting involved in 1 year options in the RMB, because I think they're massively underpriced. I think there's a huge home run trade to be had from that kind of Asian crisis on steroids kind of style opportunity there. So there are opportunities to be had. Do you need to hedge yourself? Well, if you want to hedge yourself in some way, just buy some more US bonds. Just if that's all you want to do, that's not a bad bet. But if you want to do more than that, then you might need to think about buying some options in the dollar. You need to think about, does your portfolio have a lot of oil risk in it that you didn't realize you had? Does it have emerging market risk you didn't realize it had? On the flip side of all of this, there's obviously going to be US companies that are going to benefit greatly. So for example, Walmart is all about input costs from abroad, particularly emerging markets, and they sell it to US consumers. So if the dollar and the price of goods from abroad falls, let's say 30%, then the price of inputs into Walmart fall 30%, and their margins may be able to rise 10% because they only pass on 20% of that to the consumer. So this is a really good opportunity in some of the US domestic companies. And again, the flip side of that is we need to look at companies that have high dollar exposure elsewhere in the world. They've got their hedging wrong. Think of also the oil companies and what it does to the oil companies, basic resource companies. I think it's a nightmare scenario. I think these things are going to unwind their entire secular bull market and come back down to where they were in the late 90s. So that's a really big thing to be done. What I'd like you to do, and what I wanted to achieve by doing this presentation, was just to get this on your radar screen. You just need to start thinking about these things, because it is probably a complete change to everything you've ever been looking at, because we've not had to worry over the last 8 years about what the dollar's doing, or the euro's doing, or the yen specifically. We've not had to worry about any of these things. We've not had to worry about emerging market risk per se. We've not had to worry about carry trade risk. We've not had to worry about yield risk in different markets. And I think a lot of these things that we hold dear as the safe haven trades or the easy trades are going to get blown up, or certainly at risk of being blown up. So I think if I leave you with one thing, I just say, listen, hopefully I've opened up some new thoughts to you. Stay focused, because this shit's really real.